Hello everyone, hope you the amendments which are there in terms of business combination, Ind AS 103. So the institute has added close to 18 illustrations over here. These are new questions and a few of them I would reckon as quite important. So considering that there are 18 illustrations, we would divide this into two separate videos. Today I would be doing the first 9 of them, and in the next video I would be doing the other 9. So most of these are new sums in terms of practice sums which have been added. There is, remember, no change in Ind AS 103 per se. The standard remains as it is. So we'll go to each of these questions one by one, try to solve them in a slightly faster manner. Okay, so we'll first go. So these are this is basically the list of all the questions that have been added. Well, it doesn't even fit in one slide. So these are all the questions that have been added. I would advise you to go through them from the new study material. So first of all, we have illustration 1, which is on page 16.5. We'll just go through this question. This is on barter, an asset acquisition. So we'll just read the question first. An entity acquires an equipment and a patent in exchange for 1,000 crores cash and land. The fair value of the land is 400 crores and its carrying value is 100 crores. The fair values of equipment and patent are estimated to be 500 and 1,000 crore respectively. The equipment and patent relate to a product that has just recently been commercialized. Okay. The market for this product is still developing. Assume that the entity incurred no transaction cost. For ease of convenience, tax consequences on the gain have been ignored. How should the transaction be accounted for? So if we try to understand the transaction over here, we have just a second. Okay, so over here we have a situation where the entity has land as well as cash. So as a part of the exchange, it is giving up land and it is paying cash. The question tells you that the cash paid is 1,000 crores. There is no ambiguity in this point. And in return, I am getting equipment and I am also getting patents. So is this first of all an asset acquisition or a business acquisition? Remember, a business combination is a combination where you acquire a business. A business gives you inputs. So probably equipment and patents may be taken as inputs. Processes which are used to generate inputs into outputs, and then an ability to earn outputs. When I look at only equipment and patent getting acquired, I do not see any processes to operate the equipment, processes to run the patent in order to generate a revenue. And hence this entire transaction seems to be an asset acquisition. It seems to be an asset purchase rather than a business purchase. If it is a business purchase, goodwill comes in. If it is an asset purchase, goodwill does not come in. So we are not going to account this as per Ind AS 103. Instead, we would go to guidance under Ind AS 16, property, plant and equipment. Now, what is the guidance under Ind AS 16? You try to measure the transaction at the fair value of the asset given up, unless the fair value of the asset received is more reliably measured. So when we look at the fair values over here, do we have fair values for every transaction? Yes, we look at the fair value of land being 400, the fair value of equipment and patent being 1,000, 500 and 1,000 respectively. So if I jot these fair values down, land has a fair value of 400, this is the fair value, and equipment has a fair value, if I am not wrong, of 500, patent has a fair value of 1,000. These are fair value. Now the question arises, which fair value to take? Should this be the fair value of the asset given up? What are the assets given up? Well, land is given up, cash is given up, or the fair value of the asset received. Equipment is received, patent is received. As per guidance in the standard, I'll again repeat, it is a fair value of the asset given up, unless the fair value of the asset received can be more reliably measured. So when I look at the information in the question says at the last line of the first paragraph, the equipment and patent relate to a product that has just recently been commercialized. The market for the product is still developing, which means to find a fair value of this patent, to find a fair value of this equipment would be subject to a higher degree of ambiguity, and as a result, when I try to find a fair value, the fair value of land, see, cash is absolutely certain. The fair value of land seems to be more reliable as compared to the fair value of the equipment and the patent, because they pertain to a fairly new process. And as a result, we would take the fair value of the land and the fair value of cash as the value of the transaction. So if I total this up, the transaction is worth, so your total transaction, what you are undertaking as a barter, is worth 1,400 rupees, not 1,500, not based on the fair value of the assets given up, but you are taking the fair value of the assets received. You are taking the fair value of the assets given up. The reason being over here, these appear to be more reliable because the fair value of the assets received are pertaining to a fairly new product which does not have enough processes and hence does not seem to be as reliable. So when I pass the journal entry for this transaction, my entry should be bank account debit. My entry should be, I'm paying cash over here, my entry should be patents account debit, equipment account debit to bank to land. So you will debit equipment account debit. Then you have patents account debit. This is the assets received. In return, you are giving up land and you are giving up bank. So when I'm looking at the equipment, the fair value of the equipment received is 500, but according to me that is not the reliable fair value. So what is the fair value of the entire transaction? The fair value of the assets which are given up are 1,000 of cash plus 400 worth of land, and hence the total fair value of the assets that you are giving up is worth 1,400. So I should allocate this 1,400 to equipment as well as patent in the ratio of their relative fair values, in which case I would say that equipment over here would be worth, so your total transaction price is 1,400 you will allocate in the ratio of the fair value of equipment and the fair value of patent. So equipment has a fair value of 500, patent has 1,000 into 500 upon 1,500, and patent is 1,400 into 1,000 upon 1,500. So ये जब भी अपन calculate करते हैं, so how much do we get over here? We get, I think, 467 and we get 933. So that is the amount that we take. 467 933. अगर अपन दोनों का टोटल करते हैं, this gives you 1,400. To land, remember land आपके books में 100 पे है, so when you are recording that the land is given up, it will go out at 100 only, and you are paying bank of 1,000, which means there is still a balancing figure in the entry. इसको अपन बोलेंगे to gain on barter, which will go to the profit and loss account, which comes to around, so this is 1,400, 1,100 comes to around 300. This will be taken to the P&L account. So are we clear with this? Frankly, this illustration 1 has no real correlation with Ind AS 103, except for the fact that you need to identify that as there are no processes, it is an asset purchase rather than a business purchase. Once you identify that, you go to Ind AS 16 and account for it as per Ind AS 16. Perfect. So that takes care of illustration 1. Then we go to illustration number 5. This is on page number 15. This is a fairly simple question. I would not invest a lot of time behind this question over here. We'll just quickly go through the question here. ABC incorporated a company Super Limited. So there is ABC, which incorporated a 100% owned entity Super to acquire 100% shares of another entity, which is Focus, and therefore obtain control over Focus. To fund the purchase, Super acquired a loan from XYZ Bank. So over here I've taken a loan from XYZ Bank. Remember, this is a loan at commercial rates of interest. The loan funds are used by Super to acquire the entire voting rights of Focus at fair value in an orderly transaction. Post the acquisition, Super Limited has the ability to elect or appoint or remove a majority of the members of the governing body, and also Super's management is in a power where will be able to dominate the management of Focus. Can Super be identified as the acquirer in the business combination? It's a clear-cut yes. The question has thrown a lot of clues at you where it clearly tells you that the acquirer is Super. How do you define an acquirer? An acquirer in a business combination acquires control over the investee. Control is acquired if you have power to direct relevant activities, among other things. With the fact that I own the entire voting rights, with the fact that I am able to dominate the management, with the fact that I can appoint or remove a majority of the board, Super Limited clear-cut has a power over Focus, and hence Super Limited is quite clearly taken as the acquirer. A very, very simple illustration, nothing much to focus over here. Okay, next we go to the next illustration, which is, so 1 is done, 5 is done. We go to illustration number 8 and 9. This should be on page 16.18, 16.19. Now these are also fairly simple illustrations. So this is on acquisition date. Now how do you determine an acquisition date? An acquisition date is basically determined as a date when the acquirer obtains control over the acquiree. When do I acquire control? Normally when I get legal ownership of all the assets and liabilities is the date when I acquire control over the investee. Normally this is the date when the consideration is paid and ownership of the assets and liabilities are transferred. However, entities might agree to either an earlier or a later date if it is clearly mentioned in the terms of the agreement. So these are two illustrations where the institute specifically asks you two specific things. In one of the illustration, your acquisition is subjected to a regulator's approval. Both the parties have agreed. However, there is Competition Commission which has said that this acquisition will require the approval of a Competition Commission. So we need to figure out whether the date of acquisition is the date when the acquirer and acquiree agree, or when the Competition Commission actually gives approval. And secondly, in one other question, we have agreed to a specific date as per a court-approved scheme or as per our agreement. However, your control is passing on on another date. So when we are looking at the question, we should ask ourselves that when is control passed, and control is the ability to direct relevant activities. Control comes from power, and power comes from your ability to direct relevant activities of the investee. Okay, so with that we go to illustration number 8. ABC acquired all the shares of XYZ. The negotiations commenced on 1st of January 2011, let us say, and the agreement was finalized on 1st of March 2011. While ABC obtains the power to control the operations on 1st March, special emphasis to this sentence, while ABC obtains the power to control XYZ's operations on 1st March, the agreement states that the acquisition is effective from 1st of January 20X1, and ABC is entitled to all the profits after that date. In addition, the purchase price is also based on XYZ's net assets position as on 1st of January 20X1. What is the date of acquisition? So, in this situation, we have started negotiations from 1st of January and consummated the negotiations around 1st March. And we have agreed that the control, the power to direct relevant activities will be passed on 1st March. So if I just look at this question in the first part of the question, there's a very clear-cut understanding where I say that I am obtaining the power to control XYZ on 1st March itself. In which case there is no way in which I can record the business combination from 1st of January. Now the second part of the question creates some doubts in the minds of the students, because a PC probably is based on net assets as on 1st January. We have agreed and stated in our agreement that we want the acquisition to be effective from 1st of January. In fact, dividends are also, or profits after 1st January belongs to the acquirer. Are we getting this? So generally reading this, we would conclude that the date of acquisition should be around 1st of January. However, the acquisition date is defined as the date when you acquire control. Remember, it is defined as a date on which acquirer obtains control. Control is not dividend rights. Control is not your ability to earn a profit. Control is your ability to direct relevant activities. You might be entitled to all the profits from 1st January. However, profit entitlement does not give you control. Even a non-controlling interest holder is entitled to profit. What gives you control is your ability to direct relevant activities, which is coming from 1st of March, ability to direct relevant activities, which is coming from 1st March. And as a result, 1st March 20x1 will be the date of acquisition for the purpose of this business combination. So over here, 1st March 20x1 will be our date of acquisition, because that is the date when control is acquired. Okay, we go to the next illustration, that is again on acquisition date. This is again for regulatory approval. We just go through the question. ABC and XYZ are manufacturer of rubber components for a particular type of equipment. ABC makes a bid for XYZ's business, and Competition Commission announces that the proposed transaction is to be scrutinized to ensure that competition laws are not breached. Even though the contracts are made subject to approval of CCI, ABC and XYZ mutually agree the terms of acquisition and purchase price before the competition authority clearance is given. So terms are agreed. Can the acquisition date in this situation be the date on which ABC and XYZ agree, even though CCI approval is awaited? Assume that the approval of CCI is substantive. Substantive means it has real substance. It is not a mere formality. It is not a mere administrative or procedural job. It is something which might make or break a deal. इसके लिए अपन इसको बोलते हैं substantive, not merely a procedural task. जैसे कितनी बार क्या होता है, acquisition अपन करते हैं and we file to the MCA or ROC the details of our acquisition. This is a mere procedure. This is a mere formality. The MCA or ROC really does not have any substantive or real rights to block your acquisition. However, CCI over here seems to have a substantive right to block your acquisition, in which case the acquirer, that is let us say ABC, does not get power to direct relevant activities of XYZ till the time the Competition Commission has approved. And as a result, the acquisition date is the date when CCI approval is received. When CCI approval is received, that is when you will record the acquisition. Are we clear with this? Okay, so that is taking care of illustration 9. Okay, so after that we proceed to 10. Now 10 is something which is interesting, which is important. I would want you to invest some time here. But for doing this, you need to have a fairly good understanding of the associate accounting, the equity method of accounting for associate, that is Ind AS 28. So, what is the accounting over here? Sorry. Okay, so if it is a step-up acquisition, how do we study step-up acquisition? Ind AS 103 says that if you have acquired a lot, let us say 30% stake, that does not give you control. You then acquire another 70% stake. This is the second lot which gives you control. Now, when I acquire a 30% stake, I have a significant influence. That is an associate relationship, and hence I will normally follow the equity method of accounting prescribed under Ind AS 28. In which case I will record my investments at something called as carrying value. How do we calculate the carrying value? We first calculate the cost of the investment, and to the cost of the investment, we add the share in post-acquisition profits, that may be retained earnings, or post-acquisition OCI items, other comprehensive income items like revaluation reserve, like fair value reserve, like foreign currency translation reserve, whatever is a share in equity of the investee, and equity includes, remember, retained earnings as well as other equity. So when the share in equity increases, maybe due to profits earned, that is retained earnings, or other comprehensive income like revaluation, then the carrying value of our investment changes. So if I acquire a 30% stake in the entity, I will normally follow the associate method, that is equity method of accounting, and record the investments at something called as carrying value. However, if I acquire another 70% stake, the second lot gives me control. Ind AS 103 says that in such a situation, your business combination should be recorded at the fair value. Your existing stake should be fair valued, and then it should be added along with the current stake in order to find the fair value. Okay, so the problem over here is, what will you do with the amount that you have already recorded in items of other comprehensive income like FCTR, like revaluation, etc. As you would be aware till now, other comprehensive income is made up of two items. It is made up of items which can be reclassified back to P&L. Something like FCTR can be reclassified back to P&L on happening of certain events like disposal of investment, and items which cannot be reclassified to P&L. Something like revaluation reserve is a non-reclassifiable item, in which case even if you sell the asset, the balance in the revaluation reserve will not be transferred to P&L, statement of P&L, it will go directly to the retained earnings. So what does Ind AS mention? Ind AS mentions that when I have a 30% stake, there is an associate relationship. When I acquire another 70% stake, my relationship changes from the associate to a subsidiary. I acquire control. In that situation, I will treat it as if, listen to this very carefully, I will treat it as if I am disposing of my investment in associate and acquiring a new investment, that is a subsidiary investment. Again repeating, it is as if I am disposing of my 30% stake, which was an associate, and then acquiring the entire 100% stake, which results in a subsidiary. If such a situation happens, what are we supposed to do? We are supposed to find the balance that is going to be taken into what is to be done with the OCI items. The items in OCI, if it is reclassifiable items, if you are selling the investments, the item should be reclassified to P&L account. If it is a non-reclassifiable item, the items have to be taken directly to retained earnings. So this is a base that you need to remember for the purpose of this question. It is a very good question. I would strongly recommend you to study it in a lot of detail, but you will understand this only if you have done the equity method under associates first before this question. Okay, so let us read the question. I would rate this as a very important question. Illustration number 10, a very important illustration. On 1st April 2011, PQR acquired 30% of the voting rights of XYZ, which means this gives me significant influence and hence an associate relationship. Voting rights of XYZ for 8,000 crores. PQR accounts its investment in XYZ using the equity method as prescribed under Ind AS 28, which is the correct method. On 31st March 20X2, is it the same day? No, there's a difference of 1 year. As on 31st March 20X2, PQR recognized its share in net asset changes of XYZ using the equity method as follows. The share in profit and loss is 700. The share of exchange differences, इसको अपन बोल सकते हैं FCTR, foreign currency translation reserve, is 100, and share of revaluation reserve in OCI is 50. Remember, you have to follow the double entry system of accounting, in which case अगर आपने originally investment 8,000 पे record किया हुआ है, as you can see original investment is 8,000, and if the share in equity increases due to retained earnings, due to foreign currency translation, due to revaluation, you have to record that increase into the investment as per the equity method. It is one line consolidation. You don't add it line by line. You don't take over all assets and liabilities, but you add every increase in net assets to the investment and give the corresponding effect in the reserves. So when I would have earned this 700 in my consolidated accounts, I would have passed the entry investment account debit to consolidated retained earnings. When I would have earned this 100, I would have passed the entry investment account debit to consolidated FCTR. And similarly, when I would have passed this recorded this investment, I would have passed the entry investment account debit to consolidated reval reserve. Reval reserve, remember, is a part of OCI. ऐसा अपन ने रिकॉर्ड कर दिया रहेगा. एंड हेंस अपना इन्वेस्टमेंट जो 8000 पे था वो डेबिट हुआ रहेगा पहले 700, डेबिट हुआ रहेगा उसके बाद 100 एंड डेबिट हुआ रहेगा उसके बाद 50 एंड हेंस इट वुड हैव बिकम 8850. रिमेंबर इन योर बुक्स ऑफ अकाउंट्स यू फॉलो डबल एंट्री सिस्टम ऑफ अकाउंटिंग. तो अगर कुछ डेबिट हुआ है तो कुछ क्रेडिट भी हुआ है. तो क्या क्रेडिट हुआ रहेगा? यहाँ पे रिटेन्ड अर्निंग्स क्रेडिट हुआ रहेगा, यहाँ पे FCTR विच इज अ पार्ट ऑफ OCI रिसाइकलेबल रिक्लासिफाइबल OCI क्रेडिट हुआ रहेगा एंड यहाँ पे रिवैल्यूएशन रिजर्व विच इज ऑल्सो पार्ट ऑफ OCI क्रेडिट हुआ रहेगा. लेट अस सी व्हाट इज हैपनिंग फर्दर. The carrying amount of investment in the associate as on 31st March 20X2 was therefore 8850. So ये अपन already calculate करके रखा है. On 1st April 20X2, the very next day, PQR acquired the remaining 70% stake. Now, does this 70% stake give you control? Yes. For a cash of 25,000 crores, the following additional information is relevant as on that date. The fair value of 30% interest already owned is given to you as 9,000 and the fair value of XYZ's identifiable net assets is 30,000. How should such a business combination be accounted for? Something which I would reckon as a very interesting thing. We will solve it slightly different than how the institute has solved it so that we understand it slightly better. Okay, remember your final answers still continue to remain the same. So we are at illustration 10. Illustration 10. As per Ind AS 103, a business combination occurs when you acquire control over a business. Prima facie control acquires when you have more than 50% stake in a company. So have I acquired control over the business? Yes. When did I acquire control? On 1st of April. Control is acquired on 1st of April 20X2, not on 20X1. At that point we just have a significant influence. So whenever control is acquired, Ind AS 103 says that the existing stake should be recorded at fair value. The existing stake should be recorded at fair value and any difference due to the remeasurement should be taken to the profit and loss account. So अपन सबसे पहले वो करते हैं. Your existing stake of 30% is valued currently at 8850. Your carrying value in the books is 8850. The fair value, now this is, remember, the carrying value on 1st April 20X2. The fair value of this stake again on 1st April 20X2 is 9,000 rupees. Which means, is there an increase in fair value? Yes. So what is the journal entry that we pass? Investment account debit. कितने से डेबिट करेंगे? 150 to fair value gain, and this fair value gain will be taken to the P&L account. Fair value gain which goes to the profit and loss account. This is 150, which means your investment in your books, which was 8,850, now becomes 9,000 rupees. Now comes the second point. You are acquiring you are acquiring the entity. If you are acquiring the entity, how does Ind AS treat the transaction? It treats it as if it is a disposal of associate and acquisition of subsidiary. Acha, if I am disposing my associate, then what happens to FCTR? FCTR under Ind AS 21 says that the balance in the FCTR should be transferred to the P&L on the date you dispose your investment in the foreign operation. So are we disposing our investment? Yes. And hence, what should happen to the FCTR before we proceed? FCTR has to be transferred to the profit and loss account, and hence your journal entry will be FCTR account debit to the profit and loss. When I say profit and loss, it is a statement of profit and loss. The FCTR balance, if I am not wrong, was 100? Yes. So FCTR balance I'll just put this, the FCTR balance over here was 100 rupees. So FCTR will be transferred to the profit and loss account, that is 100 rupees. Remember, this is because FCTR forms a part of the recyclable or reclassifiable OCI. So this is reclassified. Now there is also revaluation reserve. Revaluation reserve, so this is point A, this is point B. Remember, revaluation reserve forms a part of the non-recyclable or non-reclassifiable OCI. But if the investment is no longer there, ideally the revaluation reserve balance pertaining to the investment should also not be there. And hence, this will be reval reserve or reval surplus account debit, which had a balance of 50, which you will take directly to retained earnings. That will also be 50. Are we clear with this? In which case, now your reserves which are there in OCI have been cleaned up as if the associate was disposed. Now you record the acquisition of the subsidiary. So as a part of the acquisition, we are paying 25,000 crores in cash for 70% stake. We have already had investment for the balance 30%, and hence NCI will be 0. We are acquiring identifiable net assets. So over here we will have identifiable net assets. Identifiable net assets account debit. This is worth 30,000 crores. For acquiring these assets, you are paying cash. You are paying cash worth 25,000 crores. This cash helps you acquire 70% of the investment. Apart from that, you are using the balance 30% through the investment that you already have. Achha, this investment is now in your books at rupees 9,000, and as a result, you will credit 9,000. So this will be net assets account debit to bank to investment. Investment over here is 9,000. Apart from this, are we having any NCI? Are we creating any NCI? No. Investment is taken care of. The balance in FCTR, retained earnings, etc. is all taken care of. And as a result, there is no transaction cost as well. The balancing figure, if any, is attributable to goodwill. So we will debit goodwill, and goodwill over here comes to 4,000 rupees. So what the institute has done is, it has passed all these 4 entries as a part of a single transaction, and hence it maybe becomes a little complicated. We have tried to break this up into each of these entries. I have just, so let me just try to see my downloads. Okay, I think let me just complete the notes over here. So the institute over here, as you can see in your solution, has recorded it as a part of the single entry. What we have tried to do over here is record it as a part of separate entries. So this is a very important question. I would recommend you to view this question, revise this. Sorry, so I have my PDF back. So if you look at the transaction over here, what is the institute doing? It is debiting by 30,000, creating a goodwill of 4,000 as per us. FCTR is debited, revaluation reserve is also debited, retained earnings, as you can see, is credited. 250 is made up of 150 for due to revaluation of existing investment, and 100 due to FCTR. 8850, we took 9,000 because we have taken revaluation directly, and then cash. As you can see, we have just split this as 4 separate entries. You first record the gain of 150 over here, then an FCTR of another 100 to the PNL, which takes the gain to the PNL to around 250. 50 rupees going to retained earnings, FCTR, as well as revaluation reserve debited, investment debited by 150, and hence we credit by the entire 9,000. Your investment is credited by 9,000, and the goodwill figure tallies at 4,000. So this is a very interesting question. You should mark it as important. Fair. So that takes care of the illustration number 10, an important illustration. We can just tick that off as well over here. Then you have a couple of illustrations on acquisition cost and couple of illustrations on indemnification. I think we've invested a lot of time. We'll just try to do it a bit quickly. So we try to go to the acquisition cost part. What are acquisition costs? These are costs which are directly attributable to the acquisition. Now there was a difference over here between AS and Ind AS. Ind AS quite clearly says that any cost which is pertaining directly to the acquisition has to be taken to the profit and loss directly. It cannot change your goodwill. It cannot affect your goodwill. Goodwill is based on the fair value of net assets taken over. Remember, fair value of the net assets taken over and the PC that you pay. So if your fair value of net assets taken over are 1,000 crores and you are paying 1,200 crores as PC, roughly your goodwill is around 200 crores. So will the cost, like a lawyer's fees, like a banker fees, like due diligence charges, will they affect your goodwill? No, they will not. Your reputation of a target company is not higher because you appoint a very good lawyer or a very good consultant. It is independent. The expenses which are directly attributable to your acquisition are expenses and hence they should be taken to the P&L account. You will treat it as a part of business combination but not as a part of your acquisition entry. Acquisition entry is the entry that creates goodwill as a balancing figure. So there are a couple of questions over here where in each of these questions you have, let us say, stamp duty. So let us say we are doing a business combination and as a part of business combination we are acquiring land. Now to transfer land to you, you have to get it registered. You have to probably pay some stamp duty. Let us say the land has a fair value of 1,000 crores. As business combination, you should record all the assets and all the liabilities taken over at fair value. Remember, fair value under Ind AS 103. It is not fair value plus transaction cost, not fair value minus transaction cost. It is fair value. And hence, at what value should you record the land? You should record the land at 1,000 crores. Now, while you are doing a business combination, you are acquiring land. As a part of the combination, you need to pay stamp duty to get the land in your name. Does that increase the fair value of business that you are taking over? No, the land is still worth 1,000 crores and hence the stamp duty that you are paying for the purpose of that land should be taken to the P&L account as a directly attributable cost of the acquisition and hence should go to the P&L account. A similar expenditure might also come in certain intangible items like a one-time payment to be paid to the regulator in order to get the telecom license in your name. You are acquiring a company, let's say Vodafone acquires Idea. Idea has some telecom license. Vodafone wants now as a part of the acquisition the license to be in its own name and hence it has to pay some money to the regulator. That, remember, does not increase the net assets of Idea Limited. The net assets of Idea Limited are still the same. The amount that you pay to the regulator is transaction cost, which is a cost which is linked in order for you to complete the acquisition. For you to complete the acquisition, the assets and liabilities should be transferred to your name, for which you might need to pay a stamp duty or you might need to pay a one-time expenditure to the regulator, in which case these are expenses. These expenses should be taken directly to the profit and loss account. I just read these two questions in light of what we have just discussed. So which page were we on? This is 16.24 and 25. So if we go to page 25. Okay, on 24. Should stamp duty paid on acquisition of land pursuant to a business combination be capitalized to the cost of the asset or should be treated as acquisition related cost and accordingly be expensed off? As we just discussed, this should be treated as an acquisition related cost and hence should be taken to the profit and loss account because this is a cost that you are incurring in order to complete the business combination, the acquisition, and hence you will not add it to the value of land. Instead, you will take it directly to the profit and loss account. I would like to bring it to your notice that the treatment is different under Ind AS 16 and Ind AS 103. Ind AS 16, remember, is a standard for purchase of assets. Ind AS 103 is a standard for purchase of business. Both of them have different principles. If I was merely acquiring land, I will take the transaction price under Ind AS 16 as cost and then add the stamp duty to that. You will not take the stamp duty to P&L. However, if it is a business combination and I'm acquiring land as a part of the business combination, you will record land at fair value. Remember, not fair value plus or minus transaction cost, fair value. And hence land gets recorded at fair value only. The transaction cost, if any, should be taken to the profit and loss account. So acquisition cost over here should be separately recorded, should not be added to the value of the land, and should be taken to the P&L account. On similar lines as illustration 12, ABC acquires PQR on 30th June. The assets acquired from PQR include an intangible asset that comprises a wireless spectrum license. For this intangible asset, ABC is required to make an additional one-time payment to the regulator in PQR's jurisdiction in order for the rights to be transferred. Whether such additional payment to the regulator is an acquisition-related cost, again, yes, this is a cost in order for you to consummate, to complete the business combination exercise. This does not increase the fair value of the telecom license and hence cannot be added to the value of the telecom license. If this was a standalone independent asset acquisition, again you would have added to the cost. But as a part of business combination, accounting happens at fair value. The one-time payment that you make should be expensed off to the P&L account as a directly related acquisition cost. Okay, fair. Next we go to the next two questions before we reach the halfway mark. So we will stop at the halfway mark over here, which is on indemnification for today's class. So what is indemnification and contingent liability? Ind AS 103 says that we will override the standard on provisions and contingencies, that is Ind AS 37, and we will record all the assets, all the liabilities at fair value. Now, it is very much possible that the selling company has a contingent liability. Ind AS 103 says that you should consider that contingent liability and record it at fair value. So, whether it is probable or it is not probable, as a part of business combination, you will always record a contingent liability. But at the same time, you might negotiate with the seller and require him to indemnify you for loss. Indemnify means reimburse you for the loss if at all you incur a loss on the contingent liability. Now this indemnification or reimbursement is technically a contingent asset, and being a contingent asset you should not record it. However, your business combination has to be fairly represented, because if you don't record it correctly, the balancing figure of goodwill will be wrong. So the standard says that if you are recording a contingent liability and there is an indemnification for that same contingent liability, then the indemnification asset should be recorded on the same base as the contingent liability. So if you are taking over a contingent liability worth 5 crores, fair value 5 crores, and the other party is ready to give you an indemnification worth 5 crores, then you will record a contingent liability worth 5 crores and also an indemnification asset worth 5 crores. However, if the indemnification is only 3 crores, in which case you will record a contingent liability worth 5 crores and an indemnification asset worth 3 crores. Now the liability might be having a maximum value of 20 crores. You realistically think that the fair value is only 5 crores, but to get yourself secured, you take an indemnification worth 10 crores. Now this is where a problem might arise. The indemnification is for 10, the contingent liability is for 5. At what value will we recognize a contingent liability? 5. Can you recognize a reimbursement for a value greater than the liability? No, you can't. And hence the indemnification asset will be restricted to 5 crores over here. So these are the two questions. We are trying to study these two. We'll just quickly go through. This is around 16.30. So please flip over to 16.30. Okay, so we have PQR. ABC acquired a beverage company PQR from XYZ. At the time of acquisition, PQR is a defendant in a court case whereby certain customers have alleged its products contain pesticides in excess of permissible levels that have caused them health damage. So basically there's an ongoing lawsuit. PQR is being sued for damages for 2 crores. So this is the maximum amount of the liability. XYZ has indemnified ABC for the losses, if any, due to the case for an amount up to 1 crore. The fair value of the contingent liability is 70 lakhs. Remember, your maximum value might be 2 crores, but let us say you think that there is a 35% probability that pay karne ko aayega. So probably you are saying there's a 65% probability nahi pay karna hoga, 35% probability pay karna padega, and hence probably you are recording 70 lakhs roughly stated. How should ABC account for the contingent liability? Should it take over the contingent liability? The answer is yes. At what value should you take over? The answer is fair value. So what is the fair value of the contingent liability? 70 lakhs. 70 lakhs. Okay, and the indemnification asset, even though it is a contingent asset, at the time of business combination, we will take it. Okay, at what value is the indemnification given? 1 crore. Can you record an indemnification asset of 1 crore? No, you will have to restrict it to a maximum amount at which you have recorded the liability. So your indemnification asset will be recorded as an indemnification asset again to a maximum extent of 70 lakhs. What if the fair value of the liability is 1.2 crores? Yes, then you will record the liability at 1.2 crores instead of 70 lakhs. Now, will your indemnification asset still be 70 lakhs? No. Will it be 1.2 crores? No, because you don't have the reimbursement right to 1.2 crores. Then you will record it restricted to 1 crore. Are we clear with this? Yes? Okay, so a simple illustration here. The second one I think is on similar lines, in fact an even simpler one. ABC Limited pays 50 crores to acquire PQR from XYZ. PQR manufactures products containing fiberglass as has been named again in 10 class actions concerning the effects of these fiberglass. XYZ agrees to indemnify ABC for the adverse results of any court cases up to an amount of 10 crores. So can we say this is an indemnification asset? The class actions have not specified amounts of damages and past experience suggests that claims up to 1 crore each, but they are often settled for smaller amounts. ABC makes an assessment of the court cases and decides that due to the potential variance in outcomes, the contingent liability cannot be measured. अच्छा, accounts में एक principle होता है, if you cannot measure something reliability, you will not record it at all. Rather than recording a wrong number, you would not record anything at all. And accordingly, no amount is recognized in respect of the court cases. How should indemnification asset be accounted for? Should we record indemnification asset? Well, it depends on the liability that you record. Well, the liability that you have recorded is nil, and hence the indemnification asset should also be nil. You cannot record an asset for a liability that you have not accounted, and hence no liability is recognized, and hence you will not recognize an indemnification asset as well. Okay, so that takes you halfway through to the business combination changes. I hope you have enjoyed the video, and I would request you to like, share or subscribe. Thank you very much, and I'll see you guys soon. Thank you.